Hello and welcome to Short Verticals, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined by my good friend and fellow educator, Barb Armstrong, 20-plus year veteran of the financial market. She is out there in the chat. Her role in this discussion today is to help answer your questions. Your role in this discussion today is to learn and to be a part of the conversation and ask questions. Barb's going to help out with that. If you're watching this in the recorded version, thanks for being here as well. Leave us a comment. We will respond back to that as quickly as possible. So we're going to follow up today on some of the short vertical trades that we trade examples that we looked at last week as we've gone into earnings announcements, and we've got a couple of those that are happening today. In fact, we'll see the impact that those have on short vertical spreads, and we'll look over the horizon at a couple of other new potential example opportunities as we go forward with implied volatility still a little bit on the move here in the last couple of days from the VIX standpoint. So we'll see what that looks like. We'll see what the markets look like as well. A couple of quick housekeeping items as we get started with all of this. Remember that everything that we talk about simply for illustrative and educational purposes only. It is not a recommendation or advice or a specific endorsement of any particular security or pattern or strategy or idea. Remember that options carry a high level of risk that are not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commission costs and transaction costs. Also, remember that spread trading in most cases must be done in a margin account. Now, we're going to use technical analysis. We're going to use probability analysis as part of this discussion today. Remember that both of those are theoretical in nature. None of those are guaranteed. In fact, no method of evaluating the market is a guarantee of future success. All of them are theoretical. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, the other thing to think about is we're going to be using the Thinkorswim desktop software platform today, specifically the paper money version of that platform. It's a great learning environment. It's a great sandbox. It is not a guarantee of future success, and it does not do certain things that a live trading platform will do. Namely, it does not facilitate the early assignment of short options. And remember, in a short vertical spread, which is the name of the game in this discussion today, we've got a short leg. And the potential, the potential is for a short American style option, there is always that possibility that it could be assigned early, meaning the option buyer on the other side of the transaction could choose to exercise their right, use the seller of the option, will get the assignment notice and have to meet that obligation. So because there is that possibility, it's something that we want to pay attention to. Now, in a paper money account, that process is not facilitated. You will not see early assignment. In a live trading account, you may and can possibly see early assignment. And that can happen at any time, whether the option is in the money, at the money, out of the money, whether you're close to the expiration or not, there is a possibility. So be aware of that fact. Also, remember that when we talk about trades, we talk about spread trades, we're going to discuss the concept of putting stops on those trades. But remember, in general, a stop loss order will not guarantee an execution price. It'll guarantee a trigger price, but not an execution price. And a stop limit order won't guarantee the order getting filled at a particular price. So just be aware of that. Remember that past performance of any security or strategy does not guarantee future results or success. Now that we've got that out of the way, let's pop over here. Oh, one other thing I wanted to talk about really quickly before I get too far away from this. Coming up in a couple of weeks, we've got our Dallas Market Drive event. That's a one-day insights to action, full day of information. It's not curriculum driven like a workshop is, like our two-day workshops are. It is more macroeconomics and then kind of top-down view down to actionable items, a whole variety of presenters in that particular event. So the Dallas Market Drive is coming up on the 20th of September. The Chicago Market Drive is coming up on the 4th of October. And then October 10th and 11th, we're going to be in Orlando at the Orlando World Center Marriott. If you've not been there, it's a beautiful property. We're going to be there for 2 days. We're going to be talking about technical analysis and option strategy, including short vertical spreads at that Orlando event. So join us. You can get there at schwab.com/events. That's going to give you the sign-up information for all of those live events. So we appreciate you giving that some consideration. Come and join us out on the road. We have a lot of fun. These are great events. We're going to feed you. We're going to give you a good time at those particular events. So let's do this. Let's pop over to the Thinkorswim desktop software platform. Let's take a look at what's going on in the market as a whole. And taking a look at the SPX. I've talked about this a couple of times over the course of the last couple of days in the webcasts that I have taught, specifically yesterday in the trading index options webcast. But on the SPX, we've had a gap down to a hammer candle rally, gap up to another kind of hammer candle, and then a little bit of a rally today here back towards those previous highs. So some pretty solid moves to the upside, some bullishness to the SPX. That's reflective of, I think, perhaps some kind of tail end of the earnings season announcements. We've got some coming up today. We'll talk about those. And the possibility that with hiring coming in a little bit lower, with ADP numbers coming in a little bit lower, and a jobs report coming tomorrow, right? Yeah, today's Thursday, tomorrow's Friday. So jobs report coming tomorrow, those lighter numbers may be an indication, or a greater indication potentially, that the Federal Reserve may choose to cut rates. That maybe seems to be what the Fed or what the market is banking on here at this particular point, seeing that little bit of a lift to the upside. The NASDAQ index, on the other hand, doing kind of the same thing, but we see a little bit less enthusiasm. We're well off that previous all-time high, but bouncing off of that 50-period moving average nonetheless. The small caps, which arguably are going to be the larger beneficiary of a potential rate cut, seeing a little bit more solid move. Not so much yesterday, but today a little bit more solid move, up almost a full percent, 74.74% on the day so far. So across the indexes, a little bit of a move to the upside. It's a bullish day. It's not necessarily a complete, full-blown, rip your face off, risk on type of day. But it certainly is more bullish than we've seen in the last couple of days, perhaps. And if we take a look at the VIX, this is kind of the interesting paradigm here. I'm going to pop over to the VIX grid here. We still see the VIX staying relatively elevated. We kind of see the VIX staying right at its, in this case, 30-period moving average, the 30-period moving average of a 30-period average of in the money, at the money, out of the money options on the SPX. Well, why do we care? Well, this is a general gauge of how the option prices are running. When we see the VIX being relatively high, that's a general indication that overall, because remember the SPX is a reflection of a bunch of components, that overall options are a little bit more expensive. Doesn't mean that each individual option in and of itself is expensive. But with the VIX being a little bit more elevated than it has been, we're sitting here at the 15.6 handle, as opposed to down in the low 14s, there's a little bit more bullishness, a little bit more, well, not necessarily bullishness, because it's not really directional, but a little bit more premium priced in. So that would suggest that maybe being a put seller, an option seller, not just a put seller, but also a call seller, and that would include selling short vertical spreads, may be a little bit more beneficial from the standpoint of a little bit higher payout, a little bit juicier premiums. It doesn't guarantee that, and it doesn't guarantee directional movement. It just says that maybe there's a little bit more juice to work with. So we'll take a look at that as we get into this particular discussion. Now, I wanted to do this really quickly before we jump into some new examples. I wanted to talk about a couple of the trades that we put on last week, because we put them on with specific timeframes and at specific prices. We talked about, in fact, I think the title of that particular webcast was Locating Short Vertical Spreads in Time and Strike. And so I wanted to go over here to the Monitor tab, and I had put these examples in the Vertical Spreads group. And we put on 3 of these. 2 of those had earnings announcements. 1 of those not so much. As a matter of fact, we were coming off of an earnings announcement. So we had Kroger, we had Lulu, and we had NVIDIA. Lulu being the one right now that is probably the most emergent because we've got an earnings announcement coming up right now. So earnings right after the market close. Earnings on Kroger are still a little bit over the horizon here. And we saw the NVIDIA earnings last week, and we saw the kind of milquetoast response to those earnings. So let's take a look at the Lulu trade here really quickly. We located this in terms of time and location, physical location in terms of space where those strike prices were. The first thing that we did was we looked at the duration or the length of time that we would potentially be in this trade. And the reason for looking at the length of time is we didn't want to thread the needle. We could have sold a short vertical spread that expires tomorrow. In fact, we sold a vertical spread that expires next Friday. That gives us a little bit of opportunity, a little bit of time to manage this trade post the earnings announcement so that we're not trying to wrap it up on the last day when maybe the market makers have already hedged off their risk and are just waiting to try to maybe not be so nice to us to try to exit those positions. More importantly, they're not going to give us necessarily the price that we wanted on expiration Friday for a short leg that maybe we have to get out of because the price of the stock moved. They're not being nefarious. They're not being mean. They're just being what market makers are doing, simply to make a profit. That's it. It's not nefarious. It's not bad. It's just what they do. So one of the things to think about, and if you were with me in my in my index options webcast yesterday, we talked about this concept a little bit. I'm just going to draw this typical graph that we normally see, and Barb draws this one too, and so do other educators. We're used to seeing this. It's kind of that time decay or theta graph, and this side of the equation is profit and loss, or in other words, this side of the equation, not profit and loss. This is price of the option. Sorry, not profit and loss. I was drawing using the Analyze tab. That's price of the option. And this axis of this option, of this graph, is time to go until expiration. So normally, the one that we look at, the one we talk about when we're defining Greeks, is what we look at the at-the-money strike, ATM, which often has, depending on where that option is, the greatest amount of extrinsic value. Okay. And so because it has the greatest amount of extrinsic value, it's going to have the highest gamma, which we're not going to discuss in this particular case, but we have some resources that talk about this. But this is generally what happens with an at-the-money option, assuming that the at-the-money option stays kind of static price-wise, meaning the underlying stock stays static price-wise. So assuming this option stays right around that at-the-money strike, time decay accelerates as we get closer to expiration. So the greatest rate of time decay, right, the greatest theta occurs in this area right here, right, if this is our theta symbol. The greatest theta occurs kind of right in this range here. Once it starts to fall off the cliff, theta is very slow out here. So this would say, for instance, if we were looking at an at-the-money strike, benefit us if, in the case we were holding an at-the-money short strike to take advantage of time decay, or that's going to benefit us kind of as we get to this particular point where the closer we are to expiration, the faster that rate of time decay works in our favor. The challenge is, though, and I think we kind of all see that intuitively. But the challenge is when we talk about a short vertical spread, generally we are selling short vertical spreads not at the at-the-money strike. Let me ask you this. How many of you sell a short vertical spread right at the at-the-money strike and expect that there's going to be some directional movement? Maybe you do, and that's fine. That's not a problem structuring a trade that way. On the other hand, how many of you structure a short vertical spread by selling in an area where it's not likely for the stock to be, meaning an area of some higher probability of success of that trade? In other words, the short strike ending up out of the money at expiration. So if this is now our OTM, out of the money strike, right? If this is an out of the money option, here's what happens to that curve, to that theta curve. And Casey says right at about the 30 delta. And that's a common location. That's not a rule of thumb. That's just a consideration for a starting point. But I like it because that generally represents kind of that 2/3, 1/3 probability perspective. It represents generally right around the one standard deviation, maybe a little bit broader than that one standard deviation, sometimes depends. But here's what happens with an out of the money short strike or an out of the money option. Okay. And Chris says, yeah, I go as far out of the money as I can and still make a decent profit. And that's kind of that trade-off, right? That's that balance beam that we look at. So here's what happens to an out of the money option. Instead of that kind of linear logarithmic curve where price goes sideways, 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 and then drops off the cliff. The out of the money option does this. It sees the greatest amount of its time decay generally in that first third or maybe even the first half of its lifespan. And then it flattens out as it gets close to expiration. And the reason is there's just not a lot of A, directional movement, and B, there's just not a lot of theta to be had out there far off of those wings, right? Far out of that money, out of the money. Or and the other side of this would be also the deep in the money option. If we're talking about long vertical spreads, they're going to behave roughly the same way. But what that means is if this is, say, for instance, so again, remember, this is time to go until expiration on this lower, or on the x-axis. That would suggest that the greatest amount of theta occurs in this time frame, and we get a very small theta in this time frame. And that's what we're seeing right here with this Lululemon trade. Because, we would expect that implied volatility is going to eat away at this premium. But what's happening is now, because this is still far out of the money, right? Lululemon's currently trading at 203. Our short strike is at the 230 strike. The majority of the time decay has already happened for this trade, whatever time decay is going to happen. But what has also happened as we get closer to expiration is implied volatility has kind of stayed there. So we haven't lost very much in terms of time decay, and we're not likely to lose much more in terms of time decay unless the price of the stock makes a big move. So time decay not as much of a factor here in this particular case. But the reason we sold kind of a shorter length of time is because we wanted to capture kind of that rapid amount of time decay as quickly as we could, hoping that if the price of the stock did move, that gave us a little bit of cushion. And in this particular case, it really didn't, because we saw a bump up in implied volatility kind of across the board. So that's okay. We're still not losing in this particular trade, but neither are we really winning. But we're not going to gain anything necessarily by time decay between now and expiration, because time decay becomes less and less of a factor. That rate of time decay, that theta component of our option premium eating away at, is going to be smaller. So we're not as reliant upon time decay as we get down into this last week. So what we're going to be looking for in this particular case is the idea, now that we have kind of that concept in mind, we're looking for the idea of Vega sensitivity. Now, there is another conundrum here as well when we talk about Vega sensitivity. And that is this. If we look at that same kind of plot, right? And this is expiration, and this is price of the option, and this is an out of the money option, OTM, and we're looking at Vega as our option Greek here. Vega tends across the board to decrease a little bit in sensitivity as we get closer to expiration. But here's the thing: we're now down within roughly one expiration cycle. So Vega tends to be a little bit more linear in this particular case. It doesn't tend to have that same kind of standard distribution or logarithmic distribution. It tends to be a log normal, and so we tend to see this kind of linear progression. So we're now at this point, let's say right now, so we put this trade on at about 14 days to go until expiration, maybe a little bit longer, I think it was. And here we are at about 8 days to go until expiration. And now we still have a fair amount of theta sensitivity. That theta sensitivity is going to decrease a little bit, but it's still going to be there. Now, what we're benefiting from is the likelihood that implied volatility crushes post the earnings announcement. So this is the sensitivity of the option premium to implied volatility changes. But that doesn't tell us what implied volatility is going to do. This tells us how the option premium is going to react to it. So here at 8 days to go until expiration, 7 days to go until expiration, we still have a fair amount of sensitivity. So look, here's the thing. If our time decay, I'm just going to plot time decay in a different color. If our time decay has done this, now that ceases to be as big an issue, okay? Directionally, we're not seeing much directional influence because that if we're still staying out of the money, unless the price of the stock makes a big move, directionality isn't as big an influence. And in fact, let's plot this with the blue line here. In fact, delta is going to be a little bit more log normal as well. But delta is going to be now, delta could change because of gamma. Now, gamma starts to go the other direction. I don't want to get into that second order derivative here yet. But what this suggests is our biggest influence, as long as the option stays out of the money, our biggest influence as we get down to this last little bit of time frame is going to be changes in implied volatility. If that makes sense, we're just kind of plotting these influences. We're looking at what impacts the option premium the most now as we get down to those last few days. So the thing about, and the reason we went to not selling this vertical spread at tomorrow's expiration, immediately after the earnings announcement, is that we could see a directional move and implied volatility wouldn't have an opportunity to really work in our favor, and time decay is not going to help us. So the reason that we're looking at closing this trade down somewhere in this area right here is because we still have sensitivity to what is most likely to happen. We don't have a lot of sensitivity to the inevitability of time decay, but we have a sensitivity to the thing that is most likely to happen, and that is a crush in implied volatility. So given that, we're playing kind of the probabilities here and playing to the strengths of this option. So thanks for letting me kind of go a little bit deep dive into this discussion. So let's look at what we've got. And by the way, speaking of going deep dive, Barb just popped it up here into the chat. We've got a feedback survey out there in the chat. So if you liked this webcast, if this is something that you loved, give us 10. If it's something that you hated, absolutely give us a 1. But that's the spectrum. And you've got a feedback comment there, an open field. You can let us know what you like and what you'd like to see. So fill that out. Help us out to make these webcast sessions better for you. So here's what we've got. We sold it for $1.75, this vertical spread. We could buy it back right now for $1.66. Okay. And that suggests that at the moment we're making a little bit of money on the trade, but we're not going to close necessarily this trade down at this particular point. And here's the reason why. Let's go back to the chart let me grab my single grid here. And we'll look at the chart of Lululemon, L-U-L-U, Lulu. So you notice what's gone on here? Since we put this trade on, implied volatility has stayed very elevated. In fact, implied volatility overall is, if we look at the trade tab here for Lululemon, and we scroll down to the bottom of the trade tab, and we go to today's option statistics, we see that the current implied volatility percentile for Lululemon is about the 81st percentile. That means relative to the highs and lows, relative to the 52-week high and the 52-week low, this implied volatility currently, which is sitting at 67%, is really high. It's up in the upper 2/3, in fact, of implied volatility. So that suggests that implied volatility, we can see that intuitively here on the chart. We can see that implied volatility is still high. And we can also see that typically, when the earnings announcement comes out, implied volatility crushes, and it crushes pretty hard. In fact, we go back to the last earnings announcement as an example, and we see that implied volatility going sideways and then crushing hard after the last earnings announcement. So we can see that we went from 57% down to about 40%. So we lost about 17% implied volatility. 56% down to about 37%, also about 15%. Let's just call it 15% implied volatility. So if we were to lose 15% implied volatility, what would the impact be to this vertical spread? How much of an impact? Assuming price didn't move, assuming time is not a factor, because at this point, really, that theta decay is not much of a factor. If we were to lose 15% of implied volatility, what kind of impact would that have on our option premium? And so to understand that, we're going to go to the Analyze tab, and we're going to go to Lulu. And this is one that I was looking at earlier. I'm going to go to Show Positions, and here's our vertical spread. And let me kind of float this back so that we can see what that vertical spread looks like. And let's just kind of bring it in here. So here's that probable range in which the expectation is. We are short this call spread. And we go to the expiration, which is next Friday. This lighter shaded area is the probability range in which the underlying stock is likely to be, based on implied volatility, based on statistical probability. That range is where the price of the stock is likely to be. And we can see that that is below our max gain level of our short vertical spread at the 230 strike. That's our short call strike in this case. So highly probable trade still, but let's open up our price slices here. And I'm going to do this. I'm going to set our price slices to, let's do this. Let's do our base price, which is the current price, plus or minus 10%. So what I'm going to do is I'm going to do plus or minus 10%. And that'll set our two slices. So 204.40 is the current trading price of the stock. 224.82 is 10% up. 183.95 is 10% down. And so I'm going to show our price slices. And so this is the one that I'm paying attention to in this particular case. So we can see what our profit and loss is on this particular trade. Let me make sure that this is on today's date. So we want to make sure that we are here on the 4th, right? So there's our profit and loss. We're making a little bit of money on the trade so far. So we're going to be focusing on that profit and loss. So now the question is, what happens if we see a decrease in implied volatility of about 15%? So let's play the what if game. And you're right, Mighty Mouse. Lulu's earnings is today, and that's exactly what we're looking for. So we're looking for a drop. We're looking for minus 15% drop just in implied volatility. Everything else has stayed the same, right? Everything else has stayed the same. If we were to see a drop in implied volatility by about 15%, then we're going to pick up about $25 of profit in this particular trade simply from that drop, that crush in implied volatility, assuming that it drops about the same amount that it's done before. So nothing else has to happen. Okay. Okay. So Laura, and again, I understand, and that's why I'm trying to be clear and explicit about this so that we understand this. This is a little bit deeper information in terms of probability so that we understand how these factors work in our favor. So you notice we don't have a lot of theta impact. We have a fair amount of vega impact, and that's working in our favor in this particular case. So that being said, if the price of the underlying stock moves, so let's say the price of the underlying stock moves down, let's say it gaps to the downside, we could adjust. Let's say we see a move down to the 10% level, right? So down to that 10% level would be 184. So if the price of the stock were to move down 10%, what would our premium be? Well, we've gained now in that particular case about $130 in this particular trades. Okay. And Chris, you're absolutely right. Absolutely. Price movement can negate that advantage, but we don't know what that price movement is going to be. And to be fair, we don't know what the change in implied volatility is going to be, but we do kind of have some directional probability when it comes to implied volatility. It's not likely that implied volatility is going to spike up after the earnings announcement. It's much more likely that implied volatility is going to drop after the earnings announcement, even if the price of the underlying stock goes down. Because we can look at the last couple of times where the price has gapped down. In fact, gap down here and gap down here on the earnings announcement, and implied volatility did not drop. Now, this one was a little bit different. That was the April low and ran that stuff to the upside, right? So this is a highly probable trade, but we also know, again, that directional movement can make it work against us. So this is one of those things where, as we look at this trade, kind of coming back to where we are, circling back, we're going to leave this trade on until after the earnings announcement and then make a decision about exiting the trade as opposed to closing it down prior to, right? And closing it down prior to. So playing those probabilities. And Chris, 100% agree with you that there are some people that don't like to trade through the earnings announcement because of that possibility of price movement. And that's why we structured this trade specifically around that idea of giving it enough room for the price of the stock to move and still taking advantage of those inevitables. So we're going to leave this one on in this particular case. Now, here's the next one that we've got, and that is Kroger. And let's go back to the charts here for Kroger, KR. And Kroger, we were looking for this in this particular case. You can see that that earnings announcement a little bit further over the horizon, 9/11, so next week. And seeing that possible bounce to the downside. So we actually sold a little bit further out from this. Implied volatility is still rising. It's up towards the top end of its range. And let's look at this particular trade. So let's go to the monitor tab for Kroger. We sold it for 32 cents, and it's now trading for 43 cents. So we're looking at one more week of till expiration. So we're still at that point where implied volatility is a big impact. And really is still kind of having an influence. And implied volatility has been doing what in this particular case? Still going up a little bit. And overall implied volatility, remember we looked at the VIX popping up a little bit, back up above its moving average. So that's kind of working against us here. But we, again, go back to the probabilities and we say, look, the probable scenario here is that implied volatility crushes, implied volatility crushes, implied volatility crushes after the earnings announcement. So we've got a little while to go. So even though this one, we sold it for 32 cents and it's going against us a little bit here, we're not worried about this one so much. We've got a $2 wide spread, which means our risk in the trade, in this case, is $2 minus the 32 cents that we brought in. So that tells us what our max theoretical loss is, but you know, the time where we're going to get hit with that max theoretical loss is if we were to be assigned early. Now, we're still out of the money. The price of the stock is at 68. So we're not likely to be assigned early in this particular case. We still have 2 weeks to go until expiration, 15 days. So still, we're not at that point where even though it's going against us, this is where a lot of vertical spread traders, short vertical spread traders, start to get nervous when this vertical spread, which we sold for 32 cents, now starts to go against us a little bit. It's now trading at 42 cents or 44 cents. And you think, I got to do something. I got to do something. I got to adjust this. I got to manage it. I got to fix it. Sit on your hands. as Barb says, put your hands in your pockets and sit on your pockets, right? Or something like that. Some Canadian uh, aphorism that is very much more polite than I might say, just freaking leave it alone. Because Canadians are much more polite than I am generally. Just saying. That's one thing that Barb has on me, is that she is probably more polite most of the time. I've seen her though. I've seen Barb get a little bit up, kind of not polite once in a while, but it's very, very rare. All right. So in this particular instance, we're going to leave this one alone as well. So let's now look at the next one, which is NVIDIA, and then we'll look at our new example, and this is NVIDIA. So we sold this one. This is coming up again, the September 19th expiration, 15 days to go. We sold this for 50 cents. This is 97 cents. But the difference is here that this one has already worked through that earnings announcement. We saw the crush in implied volatility. So let's go back to the chart for NVIDIA. So here's NVIDIA. And we've seen that NVIDIA move to the downside. And our expectation was, in this particular trade, this was a short put spread. Short put vertical spread. We were looking for it to stay above the 170 mark. And it's currently sitting right at 170. So this is now the at the money strike. So there's two things going on here. One, implied volatility crushed. It did what we expected it to do. But now there's a reason that we might just leave this alone for just a little bit, even though there's the possibility. Now, we know that there's a possibility that we could be assigned early in this particular case. But nevertheless, somebody choosing to assign us early on this short strike is going to be giving up extrinsic value. This is the at the money strike at the moment. The price of the stock's currently sitting at 170. We're short the 170 put. And so remember, the at the money put strike, or the at the money strike, looks like that time decay curve. So we're just getting now to the point where that time decay is really starting to accelerate in our case. This is different. This is different than the out of the money. This is the at the money, right? At the money curve. So we're going to leave this on for another week, at least, to see if that works for us, see if that time decay works in our favor here, because we're at a point where that time decay is going to begin to work more rapidly in our favor. So even though it's gained about 45, 47 cents on us, we're going to hold off in exiting this trade early, fixing it, anything else. We're going to sit on our pockets and we're going to wait and see if the probabilities bear themselves out, right? Yeah, that's the thing, though. You got to think about, Greg, in terms of reward to risk. Also think about it in terms of probabilities. As human beings, we have a tendency to overweight the low probability events happening and underweight the high probability events happening. That's behavioral. That's a behavioral heuristic that we end up running into. So just keeping on it. And we could roll it, sure. All right, now let's look at one that is giving us an opportunity, ORCL, and this is a new trade. So here's Oracle. It's broken below a support level. It's giving us kind of this weird lumpy head and shoulders type of pattern with that potential of moving to the downside. A little bit of a hammer candle today, but implied volatility is high. And we've got an earnings announcement here coming up on the 9th, which is next week. So we can look just beyond that. Let's go to the trade tab. So if we've got an expiration on the 9th, or we've got an earnings on the 9th, we could look out to this one that has 8 days to go until expiration. This is the September 12th expiration. That gives us a couple of days to manage this. We could also go out to the 19th September, but let's take advantage of this highly elevated implied volatility with the probability that that's going to collapse pretty quickly. And our expectation is that the price of the stock is going to move to the downside. So I'm going to go to the September 12th expiration. We're going to look at the call side, and we're going to build a short call vertical spread, expecting downward movement. And so where I'm going to go is I'm going to go to about the 30-cent delta. And I'm going to look for tighter bid-ask spread. So $4.90 to $500, or to $4.90 to $5 is a little bit wider than $4.20 to $4.35. So I'm going to go to the narrower of the two. That's the 240 strike. It's about the 28-cent delta. And I'm going to sell that 240 strike. Whoops, let's still do this. Let's go to that one. Sell the 240 strike. and I'm going to make this $5 wide. Now, I could make it wider, but that's going to increase my maximum theoretical loss in the trade. So I'm going to keep this at $5 wide. I'm going to sell the 245. We're going to bring in $1.12 credit, which is a little bit more than 20% gain on that theoretical risk in the trade. And this is a volatility crush after the earnings, Laura. High probability trade, because we're out at the 20-cent or 28-cent delta. We could go further out. It would increase the probability, but it's going to decrease the amount of premium that we're bringing in. So we're going to collect a little bit more premium here. Click on confirm and send, read through this order. Make sure this is what we want it to do. Our max theoretical gain is 110 versus 390. We're going to put this in our vertical spreads. And I'm going to do this really quick. I'm going to go to the Analyze tab, and we're going to look at the Analyze tab, and we're going to see where that vertical spread is. Here's that probability range. Let's put this probability out to where it belongs, because we know that we've got our earnings announcement out there, and this trade is in a very highly probable location for this potential move for Oracle. So we're going to go ahead and we're going to fire this order off. Let's go to the Trade tab. Let's click on confirm and send. Once again, read through the order, make sure that we're aware of any alerts. We're going to put this in our vertical spreads group, and we're going to click on send, and we're going to fire that order off, and we got it for $1.10. So great stuff. We'll keep coming back, and we'll keep looking at that one. But if you want to learn more about time decay, implied volatility changes, all of those things, and short verticals or short options in general, come on over here to the Trader Talks webcast page. When you do that, click on the subscribe button. And by the way, remember to click on that feedback survey link that's out there in the chat. Barb is going to repost that so that you have an opportunity if you missed it before. But make sure you click on subscribe. Make sure you follow us on X at Ben Watson CS, at Barb Armstrong CS, and we would love to see you at one of these live events. Guys, thanks very much for being here with me. I know this was a deeper dive into some topics that maybe aren't always discussed, but it's something to keep in mind and think about. And the more you become practiced at trading vertical spreads, especially short vertical spreads, the more these factors kind of influence and shape your selection of strike and expiration. So have a great day. Thanks, Barb. Thanks to our great production staff and our great reviewers. We will see you guys again very soon. Take care, everybody. Bye-bye.